Everyone believes their money is theirs. They believe if they have it in the bank, they control it. They believe if they earned it, saved it, invested it, it is secure. History says otherwise. There's a moment that repeats across empires, a moment most people never see coming, a moment when governments quietly close the financial doors, not with tanks, not with soldiers, with rules. One morning you wake up, your bank is open, your account still exists, your balance still shows on the screen, but your money cannot leave. Transfers blocked, foreign wires denied, withdrawals limited, currency conversions restricted. Your wealth is not stolen, it is trapped. This is called capital control, and it has happened again and again across modern history, not in ancient times, not in medieval kingdoms, in modern countries, with modern banks, with modern laws. People think this is a conspiracy theory. It is documented financial policy. Argentina did it, Greece did it, Cyprus did it, Iceland did it, Lebanon did it, India did it in a different way. China still does it today. Capital controls are not rare. They are a crisis tool. They are a panic button. They are the financial emergency brake of governments. When money starts running away, governments lock the exits. And when they do, speed matters. Because whoever moves first survives. Whoever waits gets trapped. Most people wait. Let us start with a simple truth. Banks do not actually keep your money sitting in a vault. They lend most of it out. They invest it. They reuse it. This system works only if people stay calm. This system breaks when people rush to withdraw. That is called a bank run. A bank run is the nightmare of every financial authority because it spreads faster than any virus. One rumor starts it, one headline accelerates it, one panic tweet explodes it. When that happens, governments face a choice. Let the system collapse or trap the money inside. They choose the trap. Now here is what most people never understand. Capital controls do not begin with a speech. They begin with a weekend. Markets close on Friday. Announcements come Sunday night. Restrictions start Monday morning. Always the same pattern. Because panic grows during trading hours. Control is imposed when markets are closed. Let us go to a real case. Cyprus, year 2013. Banks were heavily exposed to failing Greek debt. Losses were enormous. Confidence vanished. People started moving money out of the country fast. The government reacted. Banks closed. ATMs limited withdrawals. International transfers were blocked. Large deposits were forcibly reduced. Not frozen, cut. Some depositors lost up to half of their balances. No vote from citizens. No approval from depositors. Emergency decree. Money trapped inside the border. People stood in ATM lines for hours. Businesses could not pay suppliers abroad. Importers could not move funds. The economy did not stop because there was no money. It stopped because money could not move. Movement is what makes money alive. Restrictions make money weak. Now go to Greece, year 2015. Debt crisis. Bank stress. Political uncertainty. What happened next followed the exact same script. Banks closed, withdrawals capped, foreign transfers restricted. People were allowed small daily withdrawals, their own savings rationed. Tourists were shocked. Citizens were angry. Authorities said it was temporary. Temporary lasted weeks. Controls lasted months. Now go further back. Argentina, multiple times. Currency crisis, debt crisis, capital flight. Each time the same move appears, limit withdrawals, limit dollar purchases, limit foreign transfers. When citizens try to protect savings, governments block the door. Because from the government view, money leaving equals system collapse. From the citizen view, money leaving equals survival. Those two goals collide, and when they collide, state power wins. Now, here's the part nobody likes to hear. Capital controls are legal. They are part of emergency financial law in many countries. They can be activated quickly. Most people never read that section of financial law, but central banks know it very well. There's another layer most people miss. Capital controls do not always look like controls. Sometimes they appear as temporary transfer limits, security reviews, compliance checks, currency conversion delays, soft words, hard effect. Money cannot leave. And in the digital era, controls are easier than ever. No trucks needed, no vaults needed, no physical barriers needed, just software rules, transaction filters, approval flags. A line of code can stop billions. You think borders control people? Financial systems control money. And when money stops moving, freedom shrinks fast. Most people think capital controls happen only in weak countries. That belief is false. Strong countries use them too. They just use cleaner language and more technical wording. They call it stabilization policy. They call it currency defense. They call it liquidity protection. But the effect is the same. Money cannot move freely. Let us talk about Iceland, year 2008. Banking sector collapsed. Currency crashed. Capital fled the country at record speed. Authorities reacted immediately. Foreign currency transfers were blocked. Investors could not move money out. Exchange controls were imposed. Those controls stayed for years, not weeks. Years. Investors were trapped inside the system, not by force, by regulation. Now look at Malaysia, Asian financial crisis, year 1998, currency under attack. Speculators betting against it, government response, capital controls, currency pegged, money movement restricted. International investors were shocked, but the state protected domestic stability. Again, same pattern. When money tries to escape, the gate closes. Now let us go deeper. There's a hidden reason governments fear capital flight. It is not only about banks, it is about currency value. When money leaves fast, currency demand falls. When currency demand falls, value collapses. When value collapses, inflation rises. When inflation rises, political risk explodes. Capital flight turns into political danger. That is when control measures appear. Not because leaders are evil, but because leaders are afraid. Fear drives financial control. There is another truth people miss. Capital controls rarely start at full strength. They start small. First comes reporting requirements, then transfer limits, then approval steps, then temporary caps, then emergency rules. Each step feels reasonable, each step feels temporary, until movement is gone. Let us talk about India. Year 2016, not classic capital controls, but a related shock, demonetization. Large currency notes were suddenly invalid. Overnight, citizens had to exchange them at banks, under limits, under scrutiny. Cash became restricted instantly. People stood in lines for days. Businesses froze. Rural trade collapsed. Money still existed, but access was controlled. Control does not require confiscation. Control requires friction. Now consider modern China. China uses permanent capital controls, not emergency controls, structural controls. Citizens cannot freely move large amounts of money abroad. Currency conversion is limited. Outbound transfers are monitored. This is normal policy there, not a crisis tool. And it works. Capital stays inside the system. Many Western analysts once mocked this model. Now some quietly study it. Because digital finance makes control easier. Think about this carefully. In the past, money was physical. Moving it required trucks, ships, gold transport. Today, money is data. Movement is permission. Permission can be denied instantly. No soldiers needed. No roadblocks needed. Just one system rule change. Transaction rejected. Now imagine a crisis. Currency stress, bond market panic, banking instability, mass withdrawals begin, authorities meet over a weekend, emergency powers activated, movement restrictions announced. It sounds extreme, but history shows it happens fast. And here is the psychological shock. People do not panic when markets fall. They panic when access is blocked. Loss hurts, but restriction terrifies. Because loss is past tense. Restriction is present tense. You can survive a loss. You cannot operate without access. Rent must be paid. Suppliers must be paid. Employees must be paid. When transfers stop, the economy chokes. That is why capital controls are powerful. They freeze the bloodstream of commerce. Now connect this with modern digital systems. Digital banking, digital identity, digital currency systems. Speed increases, control increases. Friction disappears during normal times. Restrictions become instant during crisis times. That combination changes everything. People think faster finance means more freedom. Sometimes faster finance means faster lockdown. Control scales with technology. Now connect everything together slowly, not emotionally, structurally. Capital controls are not accidents. They are policy tools. They exist in law books. They exist in central bank frameworks. They exist in emergency protocols. They are rarely discussed publicly, but they are always prepared privately. Because every serious financial authority plans for capital flight. Everyone. Stress scenarios are modeled. Bank run simulations are run. Liquidity freeze drills are studied. This is normal at the institutional level, even if it is invisible at the public level. The public sees markets. Institutions see flows. Flows matter more than prices, because flows decide survival. If money flows out faster than reserves exist, systems fail, so exits get locked. Now add modern digital infrastructure to this equation. Digital banking rails, real-time settlement systems, centralized clearing networks, programmable currency layers. The control surface becomes digital, which means it becomes instant. In the past, restrictions took days. Now restrictions take seconds. In the past, enforcement took manpower. Now enforcement takes code. This is not drama. This is system design. The more centralized the rails, the easier the switch. People often ask the wrong question. They ask, will this happen everywhere? That is the wrong question. The correct question is, can it happen anywhere? If it can happen anywhere, it will happen somewhere. If it happens somewhere, it becomes precedent. Precedent spreads faster than policy. Now consider another pattern from history. Financial restrictions are always introduced as temporary, almost always extended. Temporary taxes become permanent taxes. Temporary controls become permanent frameworks. Emergency powers rarely disappear completely. They shrink on paper. They remain in structure. Infrastructure once built is rarely dismantled. Now think about behavioral change. When people know exits can close, behavior changes early. Trust changes, allocation changes, strategy changes. Smart actors diversify access paths, not only assets, access paths. Because in every financial crisis, access matters more than valuation. A frozen million is worse than a liquid 1,000. Liquidity beats size during restriction events. This lesson appears again and again across crises. Businesses fail not only from losses, they fail from blocked cash flow. Families struggle not only from poverty, they struggle from payment interruption. Movement is life in finance. Restriction is suffocation. Now here is the uncomfortable truth. Digital convenience is training society to accept centralized rails. Centralized rails enable centralized switches. Most people trade control for convenience willingly, because convenience feels good immediately. Control risk feels distant, but history shows distant risks arrive suddenly, never gradually at the end stage. Suddenly, weekend announcement, Monday restriction. Always the same rhythm. You will notice something else in history. Restrictions never feel imaginable before they happen. After they happen, they feel obvious. People say the signs were there, the warnings were there, the patterns were visible, but patterns are invisible until someone connects them. That is what we do here. We connect patterns, not to scare, to prepare minds. Understanding systems is power. Blind trust in systems is dependence. Dependence is fragile. Understanding is resilient. Financial history is not random. It is cyclical. Control expands during crisis. Freedom expands during stability. Crisis returns. Control expands again. That cycle has repeated for centuries. The technology changes. The pattern does not. If you want to keep seeing these patterns before they hit headlines, stay here. Subscribe and lock into this channel, because we are not chasing news. We are decoding the system behind the news.